So while Tesla is shifting into a slower growth mode, the growth is still there and the stock is at a reasonable price right now. And I think this is what makes it more appealing. The stock is much more affordable, which means that if you buy the stock right now and if everything goes as planned for Tesla, the amount of return you could make by buying the stock right now is a lot higher than what it would have been if you bought this stock, say 12 months before. So the stock is at a very reasonable price right now. A lot of the businesses like the full self-driving and potentially growth of the insurance are being heavily discounted, as well as future cost savings that management can still implement as it ramps up factory and as it accused its 2020 battery day goals that will still drive margins higher. So I expect proper growth in excess or revenue growth, even if revenue growth is more in the high teens over the next 10 years instead of management 50% target. So we see a lot of upside of the stock at current price. Show me a stock the way what's interesting is, yes, they did miss their targets, their own internal targets to deliver more than 50% growth in terms of deliveries last quarter, and they missed it. They've got in, but 40 is still strong. So we need to have more clarity, more real sort of basic analysis and future guidance coming from Tesla, so we can get our sights a little bit more realistically. Yeah, I think that certainly would help management. Just for saying that we expect to grow 50% year over year in deliveries over a multi-year period horizon does not really help with year-to-year guidance, especially as Tesla is now big enough to start seeing a demand impact from an economic slowdown. Now that they've noticed they're out 1.3 million vehicles annually, they're going to start to see some consumers who may want to hold off on that next big ticket item and then wait till the next year. So while we're in a slowdown, I think management guidance and more sort of confidence they can give us around specific targets and numbers from year-to-year basis would certainly help the stock, because I think right now what the investors are searching for is the right growth rate with high growth stocks like Tesla. Even small changes in a growth rate assumptions can materially change your evaluation for the stock. Talk to us about incentives that we'll be having to be dangled in front of a US buyer. Is that a warrior? Is that a shining of a light on the fact that the price point is going to have to change? We do think there's going to be some small price cuts, as Tesla is going to want to make sure that many of its vehicles as possible, specifically some Model 3s and Model Ys, will ultimately qualify for the Inflation Reduction Tax Credit. And heading into an economic slowdown, I think that is going to be a way Tesla can generate strong demand growth. So we are modeling some price decreases for that platform next year and this year to self-generate demand growth, and that's going to help Tesla grow to what we are forecasting is a little over 1.6 million deliveries in 2023. I think my point here is that just because Tesla said a few years before that they're expecting 50% growth rate year to year over a multi-year horizon, that's a promise to make, but in reality, the reality is often disappointing than the dreams. And it's not just the reality, it's the circumstances and the global economic slowdown. You have to factor all of that in, and factoring all of that in, I think Tesla is still doing well. It's not how it is in the Wall Street, is it? You make some promise, you miss on that, you see your stock down 20% next day. But is that the reality? That is the reality. So with all the daily sort of tussles that you get, whether it's on social media or whether it's on air or whether it is about if 40% is still a pretty good growth rate, whether or not we should be looking at deliveries rather than the demand from your perspective, what is the main thing that we should focus our eyes on now when it comes to Tesla? Is it China? Is it the deliveries? Is it the demand? Which side should you be looking for? I think there are two key things that we should continue to focus on. One is, as we go into 2023, what will be the growth rate? I still expect, you said double-digit growth rate. I'm forecasting 24% growth next year in deliveries. Then what do the profit metrics look like? If you remember back, the first quarter of last year, that's where it achieved nearly a 30% gross margin in the automotive segment, and that was before the opening of the factories of Berlin and Austin. As factories productions ramp up, I do expect the gross margins to go higher, and the margins will improve sequentially. And a couple of days before, Cathie would bought Tesla stock on the day of its biggest plunge since September 2020, reaffirming her conviction in the electric vehicle maker and that many other investors have gone into. And the funds backed by Cathie Wood's firm ARK Investment Management bought more than 176,000 shares of the automaker in the first US trading session of the year. According to ARK's daily data, the purchase came as Tesla stock plunged 12% of the company after the company missed estimates for the quarterly deliveries despite offering hefty incentives. Cathie would exchange traded fund have acquired slightly more than 938,000 shares of the EV maker since October 3rd. And when they started the latest buying streak, according to ARK trading data compiled by Bloomberg. And after Tuesday's fall, Tesla is down 65% over last year due to the concerns including rising interest rates and inflation weighing on the demand for electric vehicles. So that's it guys from here today. Thank you so much for watching. Please hit the like button. It really helps me a lot, and do subscribe if you haven't already. Thank you so much for watching guys. I hope you all have a great day and a great year ahead.